The Fed locked in to cut rates next week. Bitcoin trades flat on the year. What's next for global macro? Welcome back to the Bitcoin layer. I'm Nick Bhatia. Let's start with the repo market. SOFR rates back down below 4%. Yesterday trading at 3.92. This is 2 basis points above IORB, the reserve rate paid to banks for their reserve balances held at the Fed, but it is inside the corridor, which today is at 3.75 to 4%. The Fed will be cutting rates on Wednesday in their 2-day meeting. They will be cutting rates to the new corridor, which will be 3.5 to 3.75%. Repo rates should move down by a step of 25 basis points and continue to trade inside the corridor. They're putting repo rates somewhere between 3.5 and 3.75%. As you can see from the bottom pane on this chart, the red line, which is the spread of repo rates to the reserve rate, this rate has been positive. The spread has been positive for the last several months. It has had extreme movements in that the repo rate has moved significantly higher than not only the reserve rate, but the interest rate ceiling set by the Fed itself. This has demonstrated that we have tightness in the repo market. It means that there is a scarcity of reserves or a scarcity of funds. What were some of the factors that we discussed on this show that suggested repo rates could come back down? One of them was TGA, the Treasury general account getting up to $1 trillion, and the Treasury not being able to spend money during the shutdown. That has reversed. The TGA has come back down. We'll show you that number here in a few seconds. So there has been some relief in pressure on the repo market. Additionally, the Fed has stopped QT. That means that the Fed's maturities on its securities that it currently owns are not anymore getting the balance sheet to shrink, but that those maturities are being reinvested right back into the Treasury market. This is a positive flow, but doesn't really materialize until the Fed starts to increase its balance sheet. That we are calling reserve management. So we'll look for any language in the Fed statement on Wednesday, the presser from Jerome Powell on reserve management. We're not predicting that they will resume a balance sheet expansion here, but what we are looking for is some acknowledgement that there has been tightness in the repo market, in funding, and what the Fed's portfolio, its SOMA portfolio, might do in the future to accommodate for not only tightness in the repo market, but broadly the size of the Treasury primary issuance market and how the Fed needs to be involved in some way to help grease the mechanics there of those treasuries coming from the government into the final hands. Before they reach final hands, remember, they go through the primary dealer system. Primary dealers are legally obligated to take down whatever is left over in the auction that is not purchased by other primary market participants, take those treasuries, put them in inventory, and try to work that off, meaning sell them to end users. In the process that they are working off that inventory, it is 100% funded through the repo market, meaning that the dealers that are legally obligated to buy these treasuries, they don't physically have the capital to do so. So they finance the position from an overnight funding source. For example, a money market fund. They take those funds, they send those funds to the Treasury Department for settlement of the security, take security on delivery, but then they still have that loan that they have to repay back to the money market fund. And the only way that they can pay that loan back is to sell the treasury that they have on custody. So once they sell the treasury, they get cash in, they pay back their funder, their funding source, the money market fund. The treasury, meanwhile, has already been funded because of that repo market mechanism. And now you can see here some of those numbers in context of each other. Firstly, the black line. This is money market fund assets under management. This is basically the short-term cash in the market ready to buy bills and ready to fund the repo market. You can see the purple line at 3.3 trillion. This is the overnight balance that needs to be funded from the repo source. So such as the black line has to fund the purple line. So that purple line is representative of repo volumes. That's how much money gets funded in the repo market every single night. And that number continues to go up. Why? Because the green line, which is the supply of Treasury bills, also continues to increase. The United States government is spending nominally at a faster rate than it ever has in the past, just below and bumping up against, but just below the total amount of money spent during the pandemic response. Additionally, the amount of money of the outlay of the federal government, the percentage of that is going toward interest expense, is also at a very high level and something that the United States desperately needs to address. That is why you hear the Fed chair coming online, the next one, Kevin Hassett, talk about lowering rates going forward in 2026. The surface reason will be pro-growth and to accommodate a weak labor market, but the real reason underneath the surface is that outlay, the total interest expense from the US government. In this chart right here, on the top pane, you have the total outlay and the outlay that is interest expense. So the total outlay just above 7 trillion and the interest expense at 1 trillion. That is approximately 14%. And if you look at the time series there, you can see that, yes, we did reach somewhere around that level in 2024, but now we are right up against the highs. The Treasury Department is spending an obscene amount on interest expense. Mathematically, this cannot continue for much longer without the United States having to bloat its fiscal deficit purely to pay back interest. And so the United States is in desperate need of a cheaper roll. That means that as Treasury securities come due, imagine here in 2025 that a 3-year note issued in 2022 would have been issued somewhere around 5%. Now that 3-year note is going to be closer to 3.5% at issuance. That's a 1.5% reduction in the interest rate nominally. That will be a cost savings for the United States going forward for that particular security. But think about every other security out there, from bills all the way out to 30-year bonds. What is the interest expense that's going to be paid going forward? It can only go down if rates come down in the auctions. Remember that market yields that you see, those are the yields that end up being paid in the auction, meaning that if interest rates today on the 5-year part of the curve are at 3.5%, that coupon, when it's issued, that coupon of 3.5% is the amount of interest the United States will have to pay over the next 5 years, regardless of what market rates do in the interim. That's why what's happening in the market today is essential for the United States government, because it's paying coupons in the 4s and in the 5s. Getting those coupons down to in the 3s can only happen when the debt matures and it's reissued. So that's the process that we see here, and that's what we need to see continue for the United States to continue its decent fiscal standing. Right now, there is no doubt that the United States is on the cusp of a very dangerous debt situation. I personally believe the United States will make it through. It does come down to math. And that is why lower interest rates are so important.
When you think about Bitcoin through a long-term macro lens, custody becomes one of the most important structural decisions you can make. You want durability, redundancy, and a setup that does not depend on a single point of failure. That has been Unchained's focus since 2016. Unchained is the leader in collaborative multi-sig custody and Bitcoin native financial services. They secure more than $12 billion in Bitcoin for over 12,000 clients. That means that roughly 1 of every 200 Bitcoin sits in an Unchained vault. Their custody model is straightforward. You hold 2 keys, Unchained holds 1. It is a resilient, shared custody structure that gives you an institutional-grade backdrop while maintaining individual control. Beyond custody, Unchained offers trading directly from your vault, Bitcoin collateralized commercial loans, a Bitcoin IRA where you hold your own keys, and business and trust accounts. Or opt for the highest level of private client service with Unchained Signature and get a dedicated account manager, discounted trading fees, exclusive access to events and features, and much more. If you are building a long-term Bitcoin position and want a partner that supports that responsibility without compromising sovereignty, visit unchained.com and use code TBL10 to get 10% off your new Bitcoin multi-sig vault. Right now, through the end of 2025, Blockstream is running its biggest sale yet. 21% off of all Blockstream Jade hardware wallets, no code needed, the price is automatically slashed off at checkout. This is the lowest price you'll see all year on the most trusted Bitcoin-only hardware wallet. Bitcoiners will always tell you, not your keys, not your coin, after they've seen exchange after exchange fail, rugging people out of their funds. But this isn't something you have to worry about if you own a Bitcoin hardware wallet. Blockstream Jade is the simplest, most secure way to store your Bitcoin, whether you're brand new or a hardcore stacker. Its sleek, low-profile design and full-color display with a dead simple setup lets you secure your sats in minutes. Pair it with their Blockstream app, their versatile mobile and desktop wallet, and you've got the smoothest onboarding experience in Bitcoin. As your stack grows, Jade scales with you. Air-gapped setup, fully functional QR mode with a built-in camera, native multi-sig support, and tons more advanced features. Head to store.blockstream.com right now and use code TBL for 10% off at checkout. Stock is limited and the deal will last through the end of the year. Secure your wealth before the next leg up.
We've also been going through this document since it's been released from the White House, the National Security Strategy of the United States of America, put out by the White House. If people are trying to understand what is this administration up to, what are these policies that are being levied, both on the European side of the world and in the Western Hemisphere, what's going on in Venezuela, what's going on in Mexico. The United States has a plan. This document outlines a lot of that plan, and it is in line with some of the issues we've been discussing since Liberation Day, since the Dr. Stephen Myron speech, April 7th of 2025, after the few days after the Rose Garden speech on April 2nd, 2025. So we'll include a link here to this document so that you guys can also review. But to understand that the United States does have a strategy, whether you agree with it or not, having it lined out like this is very informative. It also makes us confident that the growth impetus in the United States will continue, that next year will be a strong year for the US economy, even if we are seeing weakness in the labor market, and we are. Think about this though when it comes to the labor market. A job loss can mean two things at the same time. Number one, it can mean that because that job goes away, the marginal consumption of the economy will decline because there's one less person with a job, with income, ready and willing to spend. On the other side, the company that fired that worker is in theory now more productive, being able to produce the same output with less resources. And so that increase in productivity is healthy for the economy broadly, while the loss of the job is going to hurt net consumption. So what is the balance between these two factors? And we will only have the statistics going forward to tell us whether the lack of consumption or the increase in productivity is going to win out. We do tend to believe that the increase in productivity is the most important feature of what's going on right now with the labor market weakness. But we still have to wait and see the quality of those jobs going away, the net and the aggregate income that will go away from those jobs, and how will that consumption be replaced in the economy. Let's talk TBL liquidity. TBL liquidity is our proprietary metric at the Bitcoin layer. It combines factors such as the Treasury market and the US dollar, as well as the banking system, to give you a single high signal metric that correlates very strongly with movements in Bitcoin and the S&P 500. Check out thebitcoinlayer.com/subscribe to become a TBL Pro, gain access to TBL liquidity, our proprietary metrics, and an incredible research dashboard that we've built, which has charts and all the information you need to make great investment decisions in the Bitcoin world. Now, Bitcoin right now is in a little bit of a downtrend, has bounced off of the sub 90,000 area a couple times over the last couple weeks, but the current trend line somewhere in the upper 80s will be very important for Bitcoin to hold to keep this bull market energy going. Looking at TBL liquidity, just our raw score, you can see that liquidity, even though it had a little bit of a blip in November, it's starting to make new highs. So cyclically, we're going to watch for our indicator to start to turn up. We'll show you that here in a second. Now, on the top pane, you see TBL liquidity cycle. This is a 30-day change of that liquidity metric we just showed you. And what we've taken from the bottom pane here is the first derivative of that cycle, meaning that as liquidity is starting to turn up, it gives us a buy indicator, and the reverse being the case. Now, a few weeks ago, when Bitcoin was just above $110,000, this signal started to roll over. We applied that red dot after a few days. We needed confirmation just based on the way our indicator works. And Bitcoin did take a spill in the coming weeks after that red dot. So we'll show you that red dot here. You can see that when the liquidity metric starts to roll over, that's that bottom pane, and the purple bar is starting to go away, you see here on the middle that the slope of the cycle, our indicator, went below zero. That's why you got that red dot there. Now, looking closely at that middle pane, you can see our slope starting to turn back and potentially get to zero. So are we possibly looking at another green dot here over the next couple weeks? Definitely we'll be watching the MOVE index, which is bond volatility, and the US dollar for advanced signals there on whether our indicator will turn back positive and have supportive liquidity conditions for both stocks and the S&P 500. On this chart, we've overlaid our TBL liquidity index with the US dollar. This is DXY. You can see that DXY is inversed in that the right side of the y-axis there, it's inversed because when the dollar goes down, that's positive for liquidity. So the dollar right now going down, it touched 100. You can see now it's falling to 99. That's the green line going up now. That is supportive for liquidity. Why? Because much of the US dollar debt taken out around the world becomes put in a very dangerous and precarious position when the dollar gets stronger, and that tightens credit creation. It tightens liquidity conditions. The dollar going weaker is that condition that we need to extend credit and put liquidity back into the system. So we're watching the dollar come off a little bit, and that is going to be very important for liquidity. Now taking out the dollar and putting in bond volatility. The same thing goes with the inversing of the bond volatility metric. That is because with lower volatility, we get higher liquidity. With lower volatility, the conditions to make markets and the conditions to create credit, the conditions to finance leverage become easier. And we see the fall in bond volatility over the last few days as very supportive to the overall liquidity trend, and a part of the reason we believe that Bitcoin is holding its bull trend here as we speak. For more of our thoughts on Bitcoin's price, especially thinking about the end of the 4-year cycle, the price pattern going forward for Bitcoin versus a power law, and the fact that Bitcoin today, as it sits near a practically 0% change in 2025, is the lowest return, absolute return, either up or down on Bitcoin for the better part of Bitcoin's life. The last 10 years have had Bitcoin prices moving at least 60% in either direction. Now Bitcoin is facing the prospect of a year with 0% movement. This should be earth-shattering to Bitcoin holders, thinking about Bitcoin volatility both today and going forward. What does it mean for the price and the path of Bitcoin over the coming years, and what we believe to be a 5 to 10 year march to the $1 million mark? thebitcoinlayer.com/subscribe to become a pro. Thanks for sticking with us. I'm Nick Bhatia. We'll catch you guys next time.